Hello, I'm Steve Cress, head of quantitative strategy at Seeking Alpha, and welcome to our celebration and anniversary coming on 4 years now and 400% returns since our inception on July 1st in 2022, it was, I believe. Um, Amazing. I am joined by Emma Johnston, our quantitative strategist, and thank you for attending our webinar today. First off, a little housekeeping. We are not advising you personally connecting the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment security strategy or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by subsequent events. It represents my opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed security dealer, broker, or U.S. investment advisor or investment bank. Thank you for your patience during that. And I'd like to wish everybody a happy 4th of July week as our nation celebrates its 250th birthday. I guess Alpha Picks and our nation have something in common. It's a birthday week. So I think we're in fine company. So as I mentioned, I'm joined by Emma Johnston. So if you're new to Seeking Alpha or Alpha Picks, I'll provide you with a little background on myself. I have been in the world of finance for almost 35 years. The majority of my career was spent at Morgan Stanley, where I worked for 13 years running a proprietary desk in quantitative strategies. I also founded a hedge fund, and I founded an investment research company that, for the most part, automated investment research, and that was purchased by Seeking Alpha in 2019, and that is what has brought me here today. And it's been a great journey. And Emma, if you could tell us a little bit about yourself as well.
Thank you so much, Steve. To subscribers watching today, or excuse me, viewers watching today, I just want to remind you the chat is open and I'll tell you a little bit about myself. I'm a senior quantitative strategist with the quant team here. I've been working at Seeking Alpha for about 2 years. I contribute to some of the research and stewardship of the Alpha Picks portfolio. And prior to that, I had been working for State Street Investment Management on their systematic quantitative equity strategies. So a lot of experience in the quant world we're going to talk about more today.
Awesome. Thank you. So we'll get right into the performance, and I'm sure many of you are interested in that. So AlphaPix, as I mentioned, it has been around since July of 2022, and since its inception is actually up about 415% compared to the S&P for the same period, which is up 93%. But bringing the performance to a little bit more closer of a date, year to date, the portfolio is up 40% versus the S&P up 6.89%. And you can see on the far left-hand side, over the last 52 weeks, we are up 86% versus the S&P up 19%. So it's been a really good run since our inception and for the various time periods that we've highlighted here today. And I will also show you by calendar year. So I like to, show different time periods, and it gives a great exhibit of how Alpha Pix has performed over different horizons. So you could see for our inception year, we were up right from the get-go. In our first year, for a 6-month period, we're up 9.23% versus 2.27 for the S&P. That was a difficult year for the S&P. And then in 2023, which was a good year for the S&P, it was up 26%, but AlphaPix was up even more. It was up 58% in 2023, our first full year. The following year, AlphaPix was up 49.7%, with the S&P up 24.89. And last year, AlphaPix was up 41% versus the S&P up 17.72%. And as I mentioned, this year it's been off to a great start. Year to date, we're up almost 46% versus the S&P up only 8.25%. And it has been a very volatile year with many rotations for risk on, risk off, risk on, risk off. Between macro events and inflation and the incredible progress that's been made by AI, the market has really been all over the place. But I'm very pleased to report AlphaPix has been very consistent in picking companies with strong fundamentals, and it's come through in our track record. So on this presentation today, we're going to tell you a little bit about what quant is. We're going to provide our view on the markets and provide an economic update as well, and also provide an introduction to AlphaPix. First, I want to say what our quant vision is. So our quant vision is to eliminate emotional investing and help uncover stocks using data-driven tactics. And what we mean by that is so many investors grow emotionally attached to stocks. Perhaps they've held it for a number of years, or it could be a friend who's recommended a stock, or perhaps an individual that they hold in a very high regard who runs a company. A lot of those decisions are emotionally based. And we really do try to remove the emotional aspect from investing. We try to stick with the data. And by doing that, we believe it has proved over a long period of time that it provides us with very good performance. So, what is quant? As I mentioned, it uses data, but it also uses mathematics and algos to find investment opportunities and to help manage portfolios. And in essence, really what that means, we're really looking at the same uh, characteristics and criteria that many analysts on Wall Street look at. If you're from Morgan Stanley or from Goldman Sachs or Merrill Lynch, you tend to look at the key investment characteristics, which are value, profitability, and growth. And we really do focus on the same thing. In a nutshell, we're taking what a human analyst does, but we do try to remove the emotion that many analysts have. And analysts get attracted to CEOs and CFOs as well, or they get attracted just to stocks that have performed well, and sometimes they don't know when to let go. And what we have created with the quant system is a very disciplined approach. So we try to rely more on valuation and growth and momentum and EPS revisions than we do on emotion. And to make sure that we keep that discipline, we make it a systematic process. And that means that from our vantage point, we do this actually on a daily basis. We refresh data for thousands and thousands of companies every single day. And we look at balance sheets and income statements and cash flow statements. And we also look at hundreds of metrics, value metrics such as PE or price to book or price to cash flow. We look at growth metrics such as revenue growth or earnings per share growth or EBITDA growth. And we look at profitability, everything from gross margins to net income margin to return on equity to return on capital. And we look at that every single day. And when we look at it, we measure each stock compared to its sector. So we're not only looking at it in absolute terms, we actually look at it in relative terms to see how that company scores versus its sector. And as a result, we can rank companies from best to worst, and we can identify the strong companies and the weak companies. And we refresh our screens every day and our model every day. So that helps us keep true to our discipline. And at the end of the day, or I should really say at the beginning of every morning, we run it from 4 a.m. to 6 a.m. We can label each stock either as a strong buy or a strong sell or a hold based on how the data ranks. And we have a pretty good track record too. So what I'm showing here is an exhibit of the performance of all our strong buys. And on any given day, we have anywhere from 380 to 400 strong buys. And this isn't really for the purposes of showing you an investable product. This is not investable because most individuals, unless they have a very expensive computer system and they're systematic traders, they wouldn't be able to trade 380 stocks on a daily basis. But what we do here is we highlight what the performance would be of our strong buys versus Wall Street strong buys and the S&P 500. And this goes back 5 years. And you can see over a 5 year period, refreshing on a daily basis, our quant strong buys were up 177% versus Wall Street for that 5 year period, which was up only 12.78%. And the S&P was up about 51.8% for that period. So again, this is all our strong buys refreshed every day. If a stock were to fall out of a strong buy, it wouldn't be in the portfolio, it would be eliminated, and we would bring in the new strong buys. So again, the purpose of this is to show you how the strategy works, really how well the strategy works, which is a GARP-oriented strategy that is growth at a reasonable price. And I call it GARP Plus because we also focus on positive EPS revisions and momentum. And you can see the strategy has worked very well. So with Alpha Picks, we take that strategy, but instead of having 380 stocks, what we do is we provide two of our top recommendations every month. And that's how Alpha Picks works. And using just two recommendations, you can see we have also achieved incredible performance since inception, up 415%. And you could expect with Alpha Picks, which is a product that we have, and which has brought you here today, you would get an email twice a month, or you'd be able to go to the Alpha Picks platform and you can see what the ideas are. Each idea is written up extensively. And we also display the portfolio. We display the prices that it's purchased at. We display the weights. So it's actually a very transparent system. So you can go all the way back to July of 2022 and read the research on every single idea that we recommended. And you'll see from the portfolio and the performance pages that we track what that price was and the weight that it is in the portfolio and how we achieve that performance. So right now I'm going to get into our current market conditions, and we are faced with quite a few potholes in our current cross currents. You can see we are working with inflation, we are working through volatility, we are working through a lot of geopolitical uncertainty, and we're also dealing with markets that are at an all-time high. So there's a lot of conflicts here, and it could be very confusing for most investors, and it could be confusing even for sophisticated investors as to what position they should be taking. So by way of the cross currents, even though the market is near all-time highs, you can see the CNN Fear and Greed Index is actually in fear territory, and it's approaching extreme fear. If you look at the right-hand side, you can actually see where it is now at 24, and you can see a week ago it was at 31, and then 1 month ago it was actually in the greed territory at 59. So it's been falling rapidly, and many investors are concerned not only with AI stocks being overvalued, but they are concerned with the geopolitical events that the war is in its fourth month with Iran. They're concerned that oil has been so high for so long, and that interest rates have been so high for so long, and that the Federal Reserve seems to have a disposition towards bringing rates actually up instead of down. So this has really put the market in some difficult cross currents. And looking at the latest economic data that came out, we could see that the CPI print showed headline inflation at 4.2% year over year. And energy, if you strip that out, was up 23%. Now, this is a bit backward looking. Oil prices have fallen a lot. So some of this number is historical. I think we've seen oil fall from about $100 for its spot price down to the 70s. So that is a tremendous fall. We have not seen that fall at the pumps yet. So it's still impacting consumers. We've seen prices come down a bit, but not as much as it has at the barrel. That usually will happen, but there's a much longer tail for it to happen for consumers and happen at the pump. And that will continue to impact individuals and consumers' pockets during that period. So there is a bit of hesitation, and sentiment is more on the negative side. And as you can see, the fear and greed index shows that. So I mentioned interest rate traders before. This chart shows the interest rate traders, and you can see the current level is at a range of 350 to 375 basis points. We have a Fed meeting coming up on July 29th. And for that upcoming meeting, in terms of what the interest rate traders believe, almost 70% of them feel that rates will stay unchanged, but there's a whopping 30% of interest rate traders that actually expect the Fed to lift rates going into that meeting. And that is an incredible different picture than we saw 6 months ago. 6 months ago, most interest rate traders were actually expecting the Fed to lower rates at this period by anywhere from 25 to 50 basis points. Now they're actually expecting the Fed to take rates up. And that is because inflation has been so sticky. And you can see in terms of the sector performance, there's been a real rotation that matches the sentiment that we see on the CNN Fear and Greed Index. And that sentiment is to move to defensive sectors and safe havens. And the sectors that have performed very well in the last 5 days have been traditional defensive sectors. We have healthcare, utilities, and real estate, as you can see, up significantly compared to technology and communication services. So healthcare up about 7.3%. Utilities, a very traditional safe haven sector, up 3.2, as well as real estate up 3%. And you can see technology is down 5.4%, communication services down about 3%, and consumer discretionary stocks down 2.38%. So taking us to our next chart, to add a little bit more to the uncertainty, we have midterm elections coming up, and I neglected to mention that in the beginning, but that definitely has a big impact during years where there are midterm elections. Prior to the midterms, the markets usually are down. And you can see we have 25 different periods here on the table on the right-hand side. And you can see the largest drawdown on, well, let's just say on average, the drawdowns are about 18% prior to the midterm. But interesting, and we haven't seen that kind of pullback yet. there may certainly be more uncertainty. There could be a couple more data points that come out that bring the market down a little bit more. But the important thing to realize here is post the midterm, if you look at the markets on average for the 3 month period after the midterm election, it's up 5.8%. For the 6 month period, it's up 10.5%. And if you go a full year up, on average, the market was up 14.8%. So really, for me, that is the kind of market that I want to be buying into. After all, the name of the game is buy low and sell high. So if the market does come down ahead of the elections, which are just a few months away at this point, I would definitely be viewing that as a buying opportunity. And the other thing that I would highlight over the last 5 market pullbacks, we performed a study going back to 2010, and we took 5 corrections where the market was down 15% or more. And that was sort of our line in the sand, was down 15%. This really just proves the case with stocks with strong fundamentals, but also proves the opportunity to purchase the market when it dips. So if you just took the S&P 500 during those last 5 pullbacks and you purchased it when it was down 15% and you held on to it for 2 years, you would be up almost 50% on average. But if you applied that same strategy to stocks that had strong fundamentals and you looked at our top 10 quant stocks and you purchased those stocks when the market was down 15%, if you held those for 2 years on average, you would be up 117%. So that's an enormous return. So it really proves buy low, sell high works. And when there are opportunities and the market comes off, especially where it's sentiment driven and anxiety driven, and there's not a real systemic issue with the market, it should be perceived as a great buying opportunity. And we have found that out not only with the alpha picks and just buying, not only with the market and our top 10 quant stocks, we have found that with alpha picks as well. So this is a lot more recent. We went to the September crash in 2022, where the market had declined about 17.1%. And if you bought the alpha picks portfolio at that time when the market was down 17% and you held on to it, it would be up 396%. If you applied it during the correction where there was a liberation day, and this is very recent, April 3rd of 2025, the market was down 12.17%. If you bought the Alpha Picks portfolio at that time, you would be up 146%. And even more recently, in March 26th, with the oil shock, when the market was down 8.5%, if you bought Alpha Picks, you would be up 41% now. And that was just since March. So really, if we run into periods where the market comes off, and again, it's sentiment and anxiety driven, it should definitely be viewed as a buying opportunity. And what you want to buy are stocks with good fundamentals. And that's what we find in Alpha Picks. And we have a great case study here, too, of one of our own stocks. Emma, why don't you tell our audience a little bit about Celestica?
Sure thing. Celestica is a great example of a stock that has weathered several bouts of volatility, only to come out to the other side stronger when that sentiment abates and the market starts returning to trading on fundamentals. For those that don't know, Celestica Inc., the ticker symbol is CLS. It's part of the AI infrastructure trade, and it has, as one might expect, explosive growth. However, that isn't to say it didn't go through some difficult periods in the last year or so. We originally selected the stock on October 16th in 2023, and that was priced at about $27 then. It was actually reselected in October, about a year later. And by that point, it had appreciated by more than 300%. It was priced at $81. Now, in January of 2025, there was a really volatile period. Folks might remember the DeepSeek announcement. DeepSeek was a Chinese-based AI program that was operating at much lower costs than the models we'd seen here in the States. And that sent a lot of these AI infrastructure stocks and mega cap names just plummeting. Celestica itself actually lost about 28% in 3 days following that announcement. It was a brutal time for the portfolio. We had several AI infrastructure names that were taking hits. Celestica then rebounded in January following its earnings announcements, but then, of course, Liberation Day hit. That was in April of 2025, and we saw the stock really bottom out. It actually touched $69 a share after having been priced at $81 a share just a few months previously. However, if you were to have bought into Celestica at that point when it was trading near its lows at $69, you would have seen over 380% in returns in the time period since So, I was working for the team here then. I remember it was a difficult time because we did see quite a bit of volatility in the portfolio. I was putting together different analyses for all these stocks, but I do think Celestica is a great example to highlight because those that were patient just saw those returns come roaring back. And because it's a double pick within the portfolio, which we'll get in a little bit later, those returns certainly compounded. So great example of just keeping your eye on the ball with stocks with strong fundamentals.
Thank you really much for highlighting that. So in terms of fundamentals, AlphaPix definitely focuses on stocks that have strong fundamentals. And what we are displaying here is our strong historical track record of beating EPS and revenue estimates versus the S&P 500. And here are a number of stocks that have reported recently. And you can see 37 of the 41 picks showcased here had above earnings that beat analyst estimates for the last quarter. So again, 37 of the 41 stocks that actually beaten estimates. And on the far right-hand side, you can see we actually have a proprietary metric that we call the EPS revision grade. And this is actually the quantity of analysts that take estimates up or down versus the sector. So it's actually a relative number. And hopefully that's not too complex. Again, we're looking at the number of analysts that take their estimates up or down relative to the sector, and we measure it relative to the sector. And you can see many of these companies have A pluses, B pluses, A's. So those are very strong EPS revision grades. And it means that the analysts believe that they will have to continue to take their estimates up on these stocks, which is very positive. So now we're going to get into the AlphaPix portfolio and some highlights. And Emma, I'm going to hand it over to you.
Excellent. Thanks so much. And a reminder to folks, I've been seeing the questions coming through. Great questions. We will definitely allocate time at the end of the presentation today to get into more detail there, but please keep them coming. I'll keep an eye on them as I can. So what is AlphaPix? Steve really touched on it at the top, but I think the best way to say what AlphaPix is, it is really a distillation of the Seeking Alpha quant engine. So it shares the same systematic research foundation, and that is to really assess stocks with the strongest fundamentals, which are valuation, growth, and profitability, as well as key timeliness indicators, which are EPS revisions and momentum. We make that framework actionable by selecting 2 of the top stocks each month, and we believe these are the stocks that are best positioned for long-term capital appreciation. And when we get a little bit more into our roster of stocks, you'll see how how extreme some of those gains have been. But this result is really simple. I think AlphaPix is quite elegant in its design. It's a simple rules-based strategy with clear buy and sell criteria, which we'll again walk through later. Subscribers, of course, receive alerts when ratings change, so they can stay on top of important shifts in the portfolio's outlook and framework. And of course, performance is fully transparent. Of course, this is all data-driven, and so there's nothing to hide here, no secret sauce. We let folks know what is driving performance for the portfolio and, of course, what's detracting. So if we jump to the next slide, just a little bit of who the strategy is for, and I think this is really important. Again, another advantage to AlphaPix is that it is a buy and hold strategy. And so we target minimal trading. There is about 2 to 3 trades per month on average. Of course, the 2 additions you'll receive on a monthly basis, but then we have some sells that happen as well. And I will touch on some of the sell criteria a bit later. We aim to hold positions for at least 1 year. And I think that's a really important aspect of the strategy. Sometimes it can take a couple quarters for these stocks to pop. And so patience is required. This is not the most high frequency trading strategy, and it does require some patience. And we do target companies with a market cap greater than 500 million. This helps to minimize some of the volatility by excluding small caps or the smallest caps within the portfolio. We jump to the next slide, we can outline a bit of our buy and sell rules. So in terms of our buy criteria, a strong buy, the stock needs to have a strong buy quant rating for at least 75 consecutive days. We do target US common stocks, no ADRs. We do not include REITs in this strategy, and we like to see a 3-month average market cap greater than 500 million, as I mentioned, and a stock price greater than $10. And the stock cannot have been recommended in the past year. We do have some stocks that have been selected more than once, and that is because those stocks rank still quite at the top of our quant ratings, and our double picks have been some of the most successful portfolio contributors. In terms of our sell rules, a stock will trigger a sell if it meets the criteria of falling to a sell or strong sell rating. If the rating falls to a hold and remains at a hold for 180 consecutive days, we'll then remove it from the portfolio. There is an exception to that, and that is stocks that have returned more than 100% to the portfolio. Those we let run a bit longer and only trim our initial position to allow the remaining returns to compound, and that is really rooted in some behavioral finance research. If a company announces an M&A event in which it is the target or announces a merger of equals, we'll then sell the stock as well. And we do have a concentration limit on the portfolio. So if a stock's position reaches 15%, we'll then trim that back down to 10% to avoid concentration risk. So, Steve mentioned that the quant system and, of course, AlphaPix is really a GARP plus based strategy. GARP stands for growth at a reasonable price. And then, of course, the plus being those timeliness indicators we mentioned. And we put together some portfolio level characteristics that really illustrate the growth of the portfolio. So if you were to look at the average forward revenue growth and the average forward EPS growth, you'd see the AP portfolio really outstrips the S&P 500 by quite a bit, 21.05% versus just 8.5% for the S&P 500 in terms of forward revenue growth. And then on the bottom line, the earnings side, we see a whopping 75% average forward EPS growth for the portfolio and just a bit shy of 20% for the S&P 500. And if you were to look at this on an average forward PE basis, it really offers comparable value to the S&P 500. So you're capturing all that growth potential without paying a premium, which is, the thrust of this GARP investment philosophy and what the portfolio aims to target.
I love this table. It really demonstrates the strength of AlphaPix in regards to having stocks that are fundamentally strong. And it's exactly what you want. You want a valuation framework that's, in line or a little bit cheaper than the market, but you want growth that's significantly better. And this really demonstrates both the top line and especially the EPS growth far, far outstrip the S&P 500. And that's exactly what you want in stocks that you purchase.
Oh, and, I've mentioned what the portfolio aims to target here, and that is, of course, growth at a reasonable price. But the model does incidentally select dividend payers from time to time. So if you're an income-oriented investor, this is not the objective of the strategy, but there are opportunities within the portfolio. So we've just collated all our stocks, which are dividend payers. It offers an average forward yield of 1.46%, which is quite a bit above the average S&P 500 forward yield, which is just over 1%. Again, it's not criteria that is embedded within the methodology, but I do think it's like a great byproduct for folks who maybe wanted to double down on some of the more, income-driven parts of the fund. That's an opportunity you have within the portfolio with these dividend payers. We like to keep an eye on these. People tend to adopt or can adopt in volatile periods a barbell approach where they might allocate more to dividend-paying stocks in that period. And just going to show how dynamic the portfolio is by offering these dividend opportunities.
Yeah, I think it's a real testament to the portfolio and its diversification, where we're in stocks of different market cap levels, but companies that pay dividends as well as ones that don't pay dividend. And that diversification really helps to maximize your returns and minimize your risk over long periods of time. So it really speaks to not only the strong fundamentals of the portfolio, but its diversification as well.
And we'll touch on the AlphaPix Winners Circle. So, AlphaPix has been around for 4 years. I've been working on it for 2. And I've seen this number of AlphaPix quote unquote winners, that's stocks that have returned more than 100% of the portfolio, just absolutely explode over the last 2 years. I remember writing up commentaries on the portfolio when we would mention that maybe 7 or 8 stocks were up over 100%. And now we're at an incredible number of 18 picks that exceed 100% for the portfolio. That's across 15 individual names. You might remember I mentioned we do allow for double selections within the portfolio. And if you look at Powell Industries, for instance, that's a stock that has been selected twice. The initial allocation approaching 1,500% returns, and the second is approaching 300% returns. Celestica is another double pick where you can see near 1,100% for the initial selection and up over 300% for the second selection. So This is just a remarkable statistic for the portfolio. I believe we have 41 active picks right now, and 18 have returned over 100% to the portfolio. So definitely like to highlight that. And of course, how can new subscribers get going? I do think it's important to mention we're not an RIA, we're not a fiduciary, so we cannot provide personalized investment advice. However, for folks that are looking to replicate the performance of the Alpha Picks portfolio, our best recommendation would be to buy the portfolio allocation weights of the entire portfolio. This provides a level of diversification, is going to give you your closest approximation of our performance. Some subscribers like to use it as an idea generation tool. They may have their own tried and true investment strategy, and Alpha Picks can be a great complement to a growth sleeve of a portfolio. So you can get in there, you can read the analysis of the pick. If you think it's well suited for your portfolio, you can then leverage that. And we see all varieties of investors across the community. Part of my job is to keep an eye on comments so we can know what folks are talking about. And I just see like this massive breadth of ways people are leveraging the portfolio, and just really impressive levels of sophistication. So I do think that's one unspoken asset of the portfolio. You become a member of the community, and you can pick the brains of some really smart folks in addition to the Seeking Alpha Quant team. All right. Do we want to jump in the platform, Steve, or do we want to go straight
Yeah, I think that's a great idea. So what I'm going to do is actually bring us to the AlphaPix platform. Again, this is separate from the Seeking Alpha Premium platform or the Pro platform. It's specifically for AlphaPix. And when you're in it, you could click on the About page, and much of the information that we covered today, and there's actually a video in there as well. It tells you about how AlphaPix works, about the performance, and more importantly, what subscribers can do to sort of get started, and a little bit about the portfolio process, when we buy it, what the criteria are, when we sell, and the concept of letting our winners run. So a lot more information on the About page, which summarizes what we covered today. In terms of the analysis, you'll see a couple of the stocks up here. You can see every time we come out with a recommendation, which is on the trading date closest to the 1st of the 15th of month, we will show you our picks, and there will be detailed reports on it. And then, of course, there's the performance tab, and many of the top winners you can see right here, which Emma had mentioned, just incredible returns, 18 stocks, over 1,000%. But I do want to highlight we have losers too, and we could easily sort that if we go to the returns and we click there. By sorting with the losers, you can see we've had two stocks that are down 50%. We've had two that are down in the 40% range, a few more in the 30% range. But by and large, you can see that these are, compared to the winners, low double digits. When we go to the winners, you're looking at 4 digits, and you're looking at 3 digits. Just incredible how many stocks are up over 100% in the portfolio, let alone 1,000%. And we also have a page that you can click on, which will go over the webinars. Outside of the write-ups that we have, and we have quite a few write-ups. We have the write-ups when we actually announce the stocks on the 1st and the 15th. We also have a weekly that goes out every Friday. And we also have webinars that we do every 2 weeks as well. So really a ton of information, very transparent, to help keep you informed and help you make better investment decisions. So I just wanted you to see what the actual platform looks like. And Emma, we might as well open it up to Q&A.
Great. Steve, we've been getting all manner of questions related to Alpha Picks performance in a bear market. So maybe you could speak a little bit to how quant strong buys have underperformed in down markets. I know Alpha Picks hasn't gone through a pure bear market.
Yeah, so I think that's a really great question, and I'll bring us, particularly to these slides. These are more corrections, but I will say the quant often is like a Richter scale. I notice, and I've noticed this for really decades almost, whenever something is happening with the economy or the markets that indicates it's going to be more of a longer correction, even a short correction for that matter, we tend to see it in the quant stocks first, and they usually sell off before the market does. And there's really good reason for that. Most of the quant strong buys have made people a lot of money. So whenever sentiment starts to turn negative and anxiety starts to climb, people tend to take profits in stocks that they've made money. Now, at that point in time, when anxiety is climbing and when fears are rising, it's not necessarily a bear market or a full-on correction, but it's the beginning. And often the quant stocks could be like a telltale there that something is about to happen. So what we'll find is in the initial part of a correction, the quant stocks will often come off harder than the rest of the market will. But conversely, before the market even bottoms, investors typically start returning to stocks with good fundamentals. In fact, that's almost always the case. Fear and anxiety typically fade, and investors return to stocks with good fundamentals. So, usually, what we find is before the market even hits that low point, investors start returning to these stocks. And for me, even though I don't look at a top down or a macro approach, to me, that's kind of a sign that if our stocks start to come back while the overall market is correcting, the end is usually in sight. And that's when you really want to double down on these stocks because as you can see by this table here, the alpha pick stocks, but for that matter, stocks with strong fundamentals rebound really hard and fast to the upside when you start to come out of a correction. And that's exactly what this table proves here. Emma, hopefully that answered your question.
Yeah, definitely. Okay. Moving on. When a new pick is suggested, what value or percent of the portfolio should be invested?
So it does change a little bit. I will take us to the platform so you can see what we've had recently, and we'll be giving away a couple stocks here. So when I go to the portfolio and you look at the holdings over here, these are a few of our most recent recommendations. Now, of course, you might be thinking I'm giving this away for free, but it's very important for you to know when to sell these stocks. And that's exactly why you want to be a subscriber because you want to know when to get out of the stocks. But you can see the weights right now tend to be at the point three, I'd say between the point three and point four region. As we add stocks to the portfolio, the weight typically becomes lower. But for the most part, the range of holdings, it's typically between about 35 and 45 names. Stocks that are out of hold for 180 days, they do come out of the portfolio. So there's a bit of a process where it's a little bit systematic where names do come out of the portfolio. Or, of course, if a stock goes to sell or strong sell, it comes out of the portfolio as well. But in terms of the weight, this is what the weights are about now.
Great. And then we do allocate a hypothetical $1,000 to each new pick. So when you see
Correct.
return information, that's the hypothetical dollar value you're seeing. However, this is a model portfolio. This does not run real money. Just a reminder to folks. Okay, so we had one good question that I think is along similar lines. There's 2 alpha picks a month, but what if you have no income and only a large sum of money to invest? How do you buy the additional picks when you're fully invested?
So if you have a fixed amount of capital and no income coming in, you probably want to keep a portion of that in cash. For your own risk and safety, you'd want to keep a certain amount of cash on hand. And I think this speaks to sort of a dollar cost averaging as well. You never want to put all your eggs in one basket. So it's a good idea if you're just putting a even amount of capital to work. You probably want to go into the market over periods of time. And as such, with the Alpha Pix portfolio, there'd be 2 periods every month where you're putting some of that capital to work. And that's a great way to put capital to work because if the market were to go into a huge correction and you bought a few days ago, you'd see most of your capital depreciate significantly. So that speaks to another reason why you sort of want to even that out over a period of time.
And is there a maximum number of positions that the portfolio targets?
We do not have a maximum number that we target. What we're really providing here is investment research. And as we add ideas, we monitor that portfolio of ideas. So there's not a max number that we have in mind, and there's not a minimum number that we have in mind. But over the course of time, we know that there's usually a range of about 35 to 45 stocks in the portfolio. As I said, we do have a rule in place where if a stock is a hold for 180 days, at that point, we will take it out of the portfolio and we'll make room for new stocks.
Great. Let's see. I had a person ask about QG&I. They're a retired investor. Maybe you could speak a little bit about the other service we've recently launched, QG&I, just to give folks a flavor of that and how it compares to AlphaPix.
Yeah, absolutely. A lot of people are interested in both, and as you mentioned earlier, there's that barbell approach which we're always in favor of, and um, Alpha Pix is designed for investors that want long-term capital appreciation. It's not focused on income generation, but QG&I, it's the quant growth and income product, and that is focused on capital appreciation and income generation. So I'm going to take you to the about page there. And this is a separate product, so it's a completely different platform than AlphaPix, and it's a different platform than Seeking Alpha Premium. So with the quant growth and income, you can see the focus is long-term capital appreciation, consistent dividend income, and we use our proprietary dividend grades, which helps to minimize any potential dividend cuts that could occur. So here, this actually has a fixed portfolio of 30 stocks, where AlphaPix comes along and we tend to add a new name on the 1st and the 15th of the month. With the quant growth and income, we rebalance this portfolio every other Wednesday. So twice a month, we have a rebalance of the 30 stocks. And typically, what we find is every 2 weeks, there might be 2 to 3 new stocks that come into the portfolio and 2 to 3 that exit. So it is more of a portfolio product where it's focused on 30 stocks. The only time it would not have 30 stocks is over the course of the month if a stock is sold. And then in the next rebalance period, we would add the new name and it would come back up to 30. But here, the clear focus is for long-term capital appreciation, consistent dividend income, and reduced exposure to risk for companies that potentially could cut their dividend. And we started this product in June, and we'll give a little bit of a away here. You can see that since the beginning of June, the portfolio is up almost 6% versus the benchmark, which is the Vanguard High Dividend Yield Index. That's down about 80 basis points. You can see the average yield is about 2.94%. And I believe let's take a look at the Vanguard um, dividend yield ETF to see where their yield is. So we're at 2.94%. And VYM, which is the ticker symbol for the Vanguard High Dividend Yield Index, that yield is at 2.29%. So the yield is actually higher for quant growth and income than it is for this ETF, which is our benchmark. And you can see it's been off to a great start with the performance there, up almost 6%. And that's really in a very brief period. You normally would not see that out of dividend paying stocks, let alone 30 dividend paying stocks to be up almost 6% in 1 month. So that is off to a great start. And it's a terrific approach. If you have the quant growth and income product and you have the AlphaPix product, that really speaks to that barbell approach where you have real focus on capital appreciation and then income generation as well.
Awesome. Great overview there. We're getting a few questions around if there's a minimum investment required to join the AlphaPix portfolio. What are your thoughts there?
No, it's a subscription service. And in regards to the stocks, you can put any dollar amount that you want into the stocks. If you use a firm such as a Fidelity or a Charles Schwab or a Robinhood, gives you the ability to own fractional shares, and you could put $100 in, or you could put $10,000 in. And in regards to the number of stocks that you want to own, as I mentioned, there's about 41 stocks in the portfolio. You do not have to own all 41 stocks. You could approach it any way that meets your risk tolerance or your capital level. It's just if you want to try to track the performance that we have, you'd probably want to participate in as many stocks as possible.
Great. Getting a lot of questions. Steve, why isn't AlphaPix an ETF?
Well, we're not a broker dealer and we're not an asset manager. So we provide investment research, and that is the focus of Seeking Alpha. And we have a great platform for doing it, either through AlphaPix or from Seeking Alpha Premium or Seeking Alpha Pro. So our focus is to provide investment research. We are not an asset manager or a broker dealer.
Great. Steve, I had someone ask a question about ETF grades. I don't know if we want to dig into the premium platform and just give folks a little taste of
Sure.
that.
So this is the Vanguard high yield dividend ETF, which we use as a benchmark. And interesting enough, we do have quant ratings on ETFs, as you can see. very different than stocks. So if I were to go into stock, and let me do that just for a quick comparison's sake, let's go to sort of MU where we have a strong buy on, and that is in the Alpha Pix portfolio. You can see over the last year, it's up 821%, and Micron is up almost 300% year to date. But the factor grades that we have are valuation, growth, profitability, momentum, and EPS revisions. So by example, if you were to look in valuation here, you would see conventional metrics such as PE and EV to sales, EV to EBITDA, price to book, price to sales, price to cash flow, usually on a TTM basis, which is trailing, as well as a forward basis. And then we provide an overall grade. If we went to an ETF, so we'll go to the Vanguard ETF. Um, let's pull that up again. There we go. We do look at momentum for ETFs, but we don't look at the conventional metrics that we would for a stock. Here, we look at expenses, we look at dividends, we look at risk, and we look at liquidity. So if we wanted to expenses, you would see for the Vanguard high dividend yield that their expense ratio is 0.04, which is very low compared to the median of all ETFs, which is about 0.5%. So it gets an A plus there. So our benchmark is very cheap. If you were to look at risk, by example, you could see we're looking at standard deviation, short interest, annualized volatility, turnover, and tracking error. So these are very, very different metrics for ETFs, but I am pleased to say that we do have it for ETFs, and we do have it for stocks that pay dividends as well. So let's pull up a company that has a dividend. So we'll pull up Microsoft as the example. And when you scroll down, you can see the dividend grades, and Microsoft has an A plus for dividend safety, an A plus for dividend growth, A for consistency, and a C minus for yield. And the dividend grades are a very important part of the quant growth and income, and I will show you why. There's been significant backtest here, and you can see that if you had a stock that had a dividend safety grade of A plus to B minus, that 98% of the time, historically, you would have averted a dividend cut by owning a stock that had an A plus to B minus. So that is a very important track record. Conversely, if you had a stock that had a dividend safety grade of C plus to F, we found that 91% of all stocks that fell within that range had cut their dividends. So that's why those dividend safety grades are so important to the quant growth and income fund. It's not a fund, actually, the quant growth and income product, I should say.
And I mean, I know we're trying to cover Alpha Pix here, but we've been getting quite a few questions around the biggest differences between Pro Quant portfolio and Alpha Pix. Maybe you could speak to that a little bit.
Yeah, so it is interesting. With Alpha Pix, we actually put a survey out once of what people would like to see more of, and 50% of the people surveyed said that they wanted more frequent picks. So out of that, what we PQP was born, the Pro Quant portfolio, and what we do with the Pro Quant portfolio is that's actually rebalanced on a weekly basis. That is also a fixed portfolio of 30 stocks, but we rebalance it every Monday. And on average, over the course of a year, you can expect every week that there'll be 2 to 3 new ideas. That doesn't always work that way. Sometimes there's no ideas. Sometimes there's 6 or 7 trades. But on average, there's about 2 or 3 trades that occur every Monday. So that's a Pro Quant portfolio, fixed portfolio of 30 stocks, and it rebalances on a weekly basis with a fixed portfolio.
Excellent. I think we're coming to the end of our questions. I had a few folks ask me if there would be a replay of this, and of course there will be. You can find it at the Seeking Alpha Video Hub. It's seekingalpha.com/video, and that is where you can find the replay of this. And of course, if you have any additional questions, I urge you to leave them there. We do like to monitor comments there as well and answer further questions. I think lastly,
There's 2 things I'd want to highlight. But you have one last question. Go ahead. Ask
well,
your
I was
question.
going to say, I believe our site-wide sale is still taking place. And so folks that are interested in Alpha Pix, now is your opportunity to take 20% off for the year ahead. Would urge you to take advantage of that for our summer sale.
Yeah, I believe tomorrow is the last day of that sale, and we don't have sales often. That only occur twice a year, and this is one of them. And the price on Alpha Pix now is $399 versus normally being $499. So it's a significant savings. So if you are thinking about it, I would say definitely do it during the sale. And obviously, you can tell by these returns, your payoff would probably happen very, very quickly. So we recommend a lot of good stocks with Alpha Pix.
Excellent. All right. I think
I
that's
guess
gonna.
lastly, just want to wish everybody a happy 4th of July week. Hopefully you have a great celebration with your friends or your family, or you just find time for yourself and peace of mind. And we hope you really enjoy it. On behalf of Seeking Alpha and the Alpha Pix team, thank you so much. We really appreciate your time and attention today.
Thank you all so much. We'll talk soon. Take care.